Hello and welcome to the second part of Chapter 10. In this part we're going to develop a more sophisticated model of the monetary base and how it impacts the money supply. So first of all, we begin with an overview of the Fed's ability to control that monetary base. Well, we know that open market operations are controlled by the Fed. However, the Fed cannot control the discount window. It can influence the discount window, borrowing of course, but it can't control it. And what we can do to understand this is to split the monetary base into two components. So the component that's being borrowed and the component that hasn't. So really what the Fed has control over is the non-borrowed monetary base. And we saw that in the supply of reserves when we looked at that in the previous chapter. And I didn't offer a very good explanation at the time, but hopefully now you can see that. The non-borrowed monetary base is really what the Fed can influence. It can't influence how much borrowing, though, the banks do, because that's up to them, whether they want to take advantage of their lines of credit that they have at the Fed. So the money supply, though, is positively related to both the non-borrowed monetary base and the level of borrowed reserves from the Fed. So the borrowed part of the monetary base, if you like. Obviously, if either of those increase, it means that the money supply will increase. But the point here that we're trying to make is that the non-borrowed part of the monetary base is what the Fed can control. The borrowed part, it can't. We did a simple model of the deposit multiplier, and if you remember at the end of that we said that there were two basic problems with the simple model. The first is that the people can hold cash, and if they decide to hold cash, then the kind of cascading that goes through the banking system of deposits and lending out, etc., stops. Secondly, banks may not decide to use all their excess reserves, might decide to just sit on those reserves and not lend them out. Obviously, that's even more of an incentive the higher is the interest rate paid on those excess reserves. Depositors' decisions also are not something that the Fed can influence. So if depositors decide, hey, we're not very confident in banks at the moment, we're going to withdraw a bunch of money from the banking system, the Fed can't control that either. That money leaves deposits and goes into cash. That will automatically, of course, decrease the money supply. So the Fed watches these things. It watches how much of people's wealth is being held as money and how much of it is being held as deposits with the banks. So we know that the factors that are determine the money supply here, it's the non-borrowed monetary base and changes in borrowed reserves from the Fed. So those are the two factors here that determine the money supply. So putting all this together, we can see that changes in the required reserve ratio are something that affects the money supply. Why? Because the more the required reserves, the more the banks for any given deposit have to put aside and keep with the Fed or in the vaults at the banks. Changes in currency holdings. We know that the more that the general public wants to hold as currency, the less will get deposited in banks and the less the deposit multiplier will be able to work. Lastly, changes in excess reserves. We know that the more that banks want to hold as excess reserves, the less will get lent out, and the less will therefore be created in terms of money supply. So that's a nice summary of what we just talked about here. These are the factors that we know are going to impact how much money supply there is in the economy. And we can see those through the tools of the Fed as well, while knowing what the tools are. Okay, so let's delve into this rather more complex model. So first of all, we're going to basically define money as M1. That means as well that we are looking at just currency plus checking deposits. Now, the way in which we solve this is kind of as a trick. Two tricks, in fact. The first trick is to say that the money supply is somehow some kind of multiple, little m, of the monetary base. So whatever happens to the monetary base, that gets magnified through the banking system. And that equals the money supply. So that cascading we did in the simple model, here that little m stands for kind of that cascading. But we're going to have a bunch of other variables that are involved here, which we haven't seen before. So that's really the setup. So the second kind of assumption that we're going to use is that the desired holdings of currency and excess reserves grow proportionately with checkable deposits. So this is a big assumption, of course, but don't worry about the reasonableness of this for the moment. It just makes the model tractable. In other words, we can solve the thing. Without it, it would be very difficult to solve it. So, given that, we're going to define two new variables, little c, which is the currency ratio, that's big C over little d, and little e, which is equal to the excess reserves over deposits as well. So how do we derive the multiplier, money multiplier? Well, there's two steps, really, two big steps in terms of the analytics here. This is all algebra, there's nothing more than that, but we've got to set things up here. So first of all, let's let the total amount of reserves, cap R, equal the required reserves and the excess reserves. So RR, required reserves, plus ER, excess reserves. Total amount of required reserves are the minimum reserve ratio times the amount of deposits. So little r times d is equal to the required reserves. So if we substitute for that for RR, the required reserves in the first equation, so the definition of reserves, we're going to get R equals little r times d plus ER. And of course, the Fed is going to set required reserves to less than 1, but greater than 0. Now, let's go back to our definition of the monetary base. It equals currency plus reserves. So MB is equal to C plus R. So let's simplify that as equal to C plus R times D plus ER. R times D, remember, is the required reserve ratio, so that's the minimum reserve requirement, plus ER, the excess reserves that the banks want to hold. So the equation reveals the amount of the monetary base needed to support the existing amounts of checkable deposits, currency, and excess reserves. Now we get to the heavy lifting. So we got little c is equal to cap C over cap D, but let's rearrange that so that cap C is equal to little c times D. So it's the amount of currency is just equal to some proportion of the amount of deposits, and that's what people choose to hold. If you remember that, that just comes from the definition of that little c to begin with. And the same thing goes for little e. We can rearrange that, so ER is equal to little e times D. So in other words, the excess reserves that banks want to hold are some percentage of deposits. Now let's substitute into that equation for the monetary base. So we're just going to have little r times D plus little e times D plus little c times D. So that's currency plus minimum reserves plus excess reserves. Basically, that's what that equation says. But notice we've made everything in terms of deposits. So we can just take that D out, and that's what we do on the right-hand side of that equation. So it's little r plus little e plus little c, all times multiplied by D. Now let's divide both sides by the term in parentheses. So that's little r plus little e plus little c, and we get D is equal to 1 over little r plus little e plus little c times the monetary base. Okay, now we bring in our money supply equation. So M equals C plus D. He's written it the other way around. M equals D plus C, but it's the same thing. We know that currency is equal to C times D. So therefore we can write that M is equal to D plus little c times D. So we can simplify that as 1 plus C multiplied by D. So now we can substitute again into that because we've got an expression for D. Bring that in from the 6th line down, substitute it into that equation for M, onto on the right hand side of that equation for M, on the 8th line down, that is, and we get what's there 3 lines up from the bottom of the screen. So that's cap M, the money supply, is equal to 1 plus little c over little r plus little e plus little c multiplied by monetary base. Well, if you remember, we started off by saying that monetary base times some factor, some multiplicative factor, is going to be equal to money supply. Well, looking at that looks exactly of the same form. So our little m here is just equal to that fraction there. So 1 plus c over little r plus little e plus little c. Now, before we get, you're probably thinking, yuck. Well, I don't blame you. But before you get too kind of confused about this, let's assume that the public decided to hold no currency and that all we had was, and the banks decided to hold no excess reserves. Well, in that case, our little c there would disappear, would be 0. And on the bottom, our little e would be 0 and our little c would be 0. So we'd be left with 1 over the minimum reserve requirement. Well, hey presto, that's what we got originally as our deposit multiplier, if you remember. So this is just a more complicated version of the deposit multiplier, which we're now calling the money multiplier because it takes into account the public's desire to hold cash and the bank's desire to hold excess reserves. So let's go through an example of this. So first of all, required reserve ratio is 10%, so that's 0.1. Let's say the currency in circulation was 400 billion, checkable deposits were 800 billion, excess reserves were 0.8 billion. Well, the money supply here would be just C plus D. So you can see it's going to be 1,200 billion. Little c would be 0.5. Little e would be 0.001. So the money multiplier, we can now work it out. It's 1 plus little c, so 1 plus 0.5 divided by little c, well, that's 0.5, plus little e, that's 0.001, plus little r, well, that's 0.1, that's 10%. So if we look at that fraction, on the top it's going to be 1.5, on the bottom it's going to be 0.601, which is near enough 2.5. In fact, it's just less than 2.5. Notice if we had a simple multi-multiplier, it would be the simple deposit multiplier, it would be 1 over 0.1, so that's 10. So the fact that people want to hold cash, the fact that the banks want to hold excess reserves lowers the money multiplier basically from 10 to 2.5. So there you go. All right, the last part here is just to talk about quantitative easing and the money supply. So we've already really talked about quantitative easing in the previous chapter, but just to talk about it a bit more, we have, and by the way, this is happening right now too with the coronavirus recession. So large-scale asset programs, asset purchase programs. So these are not, by the way, open market operations in the traditional sense. They are purchasing assets from the banks which are not government bonds. So maybe corporate bonds, and also purchasing from other types of financial institutions other than banks. So by June 2014, these purchases of securities had led to a quintupling of the Fed's balance sheet and a 377% increase in the monetary base. Now, some people said, well, that's going to lead to huge increases in the money supply, and consequently as well, that's going to lead to runaway inflation. Well, it hasn't. Part of the reason is that, in fact, the money multiplier hasn't gone up so much because C has increased and E has increased, little e. We're going to see that in a second. So that's where the name quantitative easing comes from. It's quantitative in the sense that you're buying assets, and it's easing in the sense it's a more relaxed monetary policy. It's a looser monetary policy. So, excess reserves here rose dramatically, and actually the Fed got a bit frustrated about this to begin with, because it meant that some of the money that the Fed was trying to pump into the economy wasn't getting to the economy simply because the banks were sitting on it as excess reserves. Here you can see the monetary base during that time. You can see it jumped at the end of 2008 going into 2009 and then continued to increase. Notice that the money supply did increase, but much less rapidly. That's because of the following changes. You can see the currency ratio actually fell slightly, but what did go up considerably was the excess reserve ratio. Now we'll return to the kind of Brandl stuff. He's got a little bit different material in here, but pretty much the same. So we know that the monetary base can be changed through the tools of monetary policy, which you know what those are by now, and also affected by the commercial banks and the cash holding public. That's through changes in little c and changes in little e, if you remember. Now he does add some value here by talking about foreign exchange intervention. So when the Federal Reserve Bank of New York sells dollars and buys yen, obviously the monetary base is going to be affected. How? Well, because the Federal Reserve Bank of New York is selling domestic currency and buying foreign currency, and therefore there's more dollars in the economy. So that will be a monetary expansion. If the Fed did the other thing, in other words, it bought dollars and sold yen, that would actually be a monetary contraction, because it would be buying dollars, it would be taking dollars out of circulation. When the Fed buys the yen from a commercial bank, it deposits dollars into the bank's account of the Fed, and bank reserves increase. So once again, the Fed can actually act to change the money supply through foreign exchange intervention if it likes. So that's another form, another kind of tool of monetary policy if it wanted it to be. But usually the Fed intervenes in the foreign exchange market for foreign exchange market reasons and not for monetary policy reasons. So often what the bank does is actually sterilize, what's called sterilize those foreign exchange purchases or sales. Next, the Treasury deposits at the Fed. The monetary base is affected when the federal government makes purchases or collects taxes. Treasury transfers funds between different accounts to ensure federal spending does not significantly affect the monetary base. So the Fed tries to neutralize the effect of whatever the government's doing on the fiscal policy side so it doesn't impact monetary policy. Now, he just presents this slide, which I think is woefully inadequate, and he's used different symbols. So little k here for his formula for it's the same formula, but little k here is the equivalent of what we covered as little c, and then his R subscript R is the reserve requirement, so we just call that R, and then R subscript little e is the excess reserve ratio, and we just call that little e. So he's got some slightly different notation, and that's why I said there are some differences here. So you must be aware of that when it comes to doing some of the Apnea exercises, etc. So his money multiplier, it's the same theory, the same framework, the same logic, the same derivation, but it's just he's given his symbols different. He's given his notation different symbols. I think that's to avoid a lawsuit, to be honest, because the previous what I went through was the guy who actually made up that framework. So, and here he just talks about the currency ratio, and he should have done the excess reserve ratio. So what might make the currency ratio change? It's a good question. What's the ultimate impact of this change? Well, the first reason why it might change is the level of financial market development. So in other words, if the financial markets are a lot more developed, then we might think, well, we don't need to hold so much currency anymore. Let's lower the amount of currency we hold because we can access assets and convert them into cash fairly easy. So an increase in liquidity basically can occur fairly easily. If it's less easy to make your assets liquid, then of course little c, the currency reserve ratio, what he's called K here, would be higher. Second, the public mistrust the banks. If people fear that there's going to be a bank run, or a bank's going to go bankrupt, or something along those lines, then people are likely to want to draw their money out from deposits and hold it as cash. So that would increase the currency ratio. Change in the excess reserves. So little e is the amount of excess reserves in the banking system, and we talked about the inverse relationship already. If there's less bank lending, it means less new money is being created, and thus the money multiplier is going to be smaller. The reserve ratio is another tool of monetary policy, and if banks are holding more reserves, then they're lending out less, very simply. So, that's exactly what would happen. And as I said before, the required reserve ratio here, the little r, is the important variable, and that doesn't really change in the US. Now, as I said earlier, reserve ratios are the favored tool of monetary policy in many other countries, though. So if you're living in China, for instance, that's the main way that the People's Bank of China does their monetary policy. And if you're in a developing country, typically that's the way as well in which monetary policy is implemented, is through the required reserve ratio. Here he talks about money supply process and quantitative easing. We've talked about that in a way. Here you can see excess reserves, again, going up through the roof during the Great Recession and continuing to rise. Part of that is because, of course, the Fed now offers interest on those excess reserves as well. And that's the end of this chapter. Thank you very much for listening.